Welcome to this week's special presentation titled Successful Investor Portfolio Update. What are we doing now? Topping markets have their own particular challenges. VectorVest has been navigating them successfully for decades. Back in November, I shared the idea of using a systematic approach to trading your portfolio and how we were trading the market and a practical demonstration of how that is expressed in our successful investor portfolio. I'll share some resources for you at the end of the presentation if you'd like more background onto what we're presenting tonight. To do a quick recap to set the scene, this graphic is a visual representation of the successful investing approach. The outer ring of the graphic shows us the high-level goals, techniques, and mindset that we're going to apply in our trading system. So this graphic is a visual representation of the successful investing approach. Our goal is to outperform the broad market, which has historically been about 10%. We position trade high VST stocks for weeks to months, but are hoping to hold positions for as long as we can. Our mindset is to take a slow, methodical approach that we can execute at any time of the day in just a few minutes. The inside of the pie chart are the details of our trading plan. Now, you might recall that all trading systems should have rules for when to buy, what to buy, and when to sell. So on the when to buy, we're only going to buy stocks when the market is rising after a bullish market signal. We'll confirm market follow-through as you take your trade. Adjust your approach for the market timing phase, which we're going to talk a lot more about in tonight's presentation. For the what to buy, we buy high VST stocks with persistently rising price and earnings patterns that are following through with the market on the day that we buy them. For when to sell, selling is necessary to limit risk and capture gains. So our selling decision has to complement our buying decisions. Step into the market just a few trades at a time and diversify your portfolio. Use a stop loss that limits risk to the portfolio of 1 to 2% per trade and adjust your stops to lock in gains quickly and minimize any risk. We also trade the market to the downside, and so we have a pie chart for falling markets where we just turn the model on its head, although the mechanics do get modified, change a little bit for the different nature of downtrending markets. But we'll short stocks and or buy contra ETFs in that environment. But we're talking about the current environment, so let's take a look at the VectorVest program. So where are we now? What have we been coaching our clients to do? Well, let's just step through that pie chart. We'll start with the when to buy, market timing. We have a mildly bullish market timing gauge with a color guard that has a majority of yellow lights, which is rather neutral, but with a bullish bias and signs of strengthening into the close today. And most importantly, we want to have this green light in the top square of the price column as our buying signal in Successful Investor. So that green light, whether it's a kicker or not, we want to see a green light in that price column. That's our buy signal. Now, to keep it really simple, you can simply buy a stock on follow-through, right? As long as the next day's market rises, buy a stock that's also rising on the follow-through after you get that green light. The probabilities of market trend are in your favor, right? Because we're still getting green lights and your stock is still rising. With just a little bit more work, however, we can get a much more nuanced understanding of the market situation, particularly when we're approaching possible turning points. And currently, it's been the MTI flashing us warning signals as its value has been well above a value of 1.50, which has historically been a measure of topping MTI values. Now, Jim Penna did a great presentation on December 7th on the MTI, and again, I'll share that resource with you at the end of our session. Let's apply what we've learned to the current market and how it will impact how we trade. Here's a graphic that illustrates how we use the MTI to identify the market cycle and those potential turning points. So we start on the left where the MTI is below 1.0, so we're in downtrend and we're at bottoming levels at 0.6. And the MTI starts rising up off of those lows in what we call the explosive phase or the blast off phase, particularly as buyers come back into the market and we see price advance very quickly. As the MTI continues to rise, it'll eventually cross above 1 and enter from weakening downtrend into uptrend. As it continues to rise, then we're in strengthening uptrend until we get to this value of about 1.5. Historically for the US and other markets, Australia and Canada use a value of 1.2. When we get to those levels, you'll start hearing commentary from us that the market is looking toppy or looking for a top. And what we're really expressing is as we get to the late cycle highs, then the probabilities start to reverse, right? The risk of the reversal and the start of the downtrend starts to get elevated relative to the probabilities of a continuation higher. When the market rolls over, then the MTI starts to fall, but it's still above 1, so we're in weakening uptrend until we finally cross below 1. Now we're in downtrend that is strengthening until we come back into the bottoming levels, and the cycle repeats. So where we are recently, we saw the MTI cross above that 1.50 threshold, and so we're at these elevated values for the MTI, meaning we're looking at toppy market conditions, and so we want to be more careful. Back in the program, let's go to the Graphs tab, and I'll open a market timing graph. I have on the graph the price of the VectorVest composite and just the MTI on the subgraph. I've put horizontal lines at the value of 1.5 and 0.60. So let's just run through this. We're looking at a 1-year time frame. If we start from the left, the MTI was below 1 and falling, although it hadn't gotten down to these oversold levels of 0.60. I also note that the MTI is no longer the smooth theoretical curve. It has bumps and wiggles. So just because it's trending does not mean that it needs to necessarily go all the way to the extremes of being overbought and oversold. But when it does get to those extreme levels, both overbought and oversold, the reversions to the mean tend to be stronger. Now let's activate a date line, and we can see that our downtrend here on the left-hand edge of the graph the MTI started to rise, indicating weakening downtrend. We finally crossed over into uptrend, a great time to start buying stocks. As the trend continued to move higher, it ultimately got to a point where the MTI got above 1.5. So how long was it before the market actually peaked? Well, on an intraday basis, 1-2 days before we actually put in the high, the MTI rolls over, falls back below 1.5, but notice it didn't go all the way to baseline. It actually started to pick up again. Uptrend resumes. We cross back above 1.5. And how long did it take before the market actually peaked this time? 1, 2, 3, 4, 5, 6, 7 days. Enough time to continue to accrue gains on the established positions, but difficult to make sufficient gains on new positions before the market would roll over. So let's slow or stop our buying when we get above this level of 1.5. When the market pulls back, as it did after this peak, any stocks that are in the portfolio are still being managed by their stops. We'll close those positions and reduce our risk exposure to the market. It's too early to go short right after the peak because the market is still rising. It's just pulling back into weakening uptrend. Eventually, in this case, however, it did cross back below 1 into downtrend. In fact, went all the way down to bottoming levels. And the cycle repeats. So this happened again. We peaked here in July. MTI at 1.51. Let's make sure that was the first day. And so from here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days before we actually put in the intraday high. And so typically it's 1 to 14 days before we get from the crossover above 1.5 to the actual peak in the market. Now, of course, it can stay elevated for extended periods of time, particularly when you've had extended or deep sell-offs, corrections like COVID or the great global financial crisis. So I have to put typical in quotations, but where are we now? Well, here we are. We've crossed back above 1.5, and it's been 1, 2, 3, 4, 5 days before we put on the intraday peak. We're 6 days into the move. Is that the peak? Yeah, I don't know. The cycle hasn't completed yet, right? But I'm certainly back to these topping levels. So our coaching has been, if you missed it, slow or stop your buying. If you want to take on new positions, do so defensively, one at a time, half positions, etc., the things that you would do to mitigate the risk of buying in late in the cycle. So I want to differentiate here between strategic approach, right? We're at topping levels, so we know we're at a potential turning point, so we're slowing or stopping our buying, but the tactical signal is our green light. So if you're going to add or buy good stocks when the market and the stock are moving higher, in a topping market condition, you want to do so defensively. Of course, if we break down from here, the first thing you'll see is the primary wave change from up to down. Stop buying. Right? You can't get a green light if the primary wave is down. We'll tighten stops in the successful investor portfolio if the confirmed call turns to down and we get red lights in the price column. We'll also start shorting stocks on red lights or buying contra ETFs. You might just move back to cash. But do you see how the timing signals are our tactical trigger? So as best we can, we want to develop rule sets that have objective triggers to keep us and our emotional selves at bay. So next I want to demonstrate how this translates into a portfolio. So I'll use the example portfolio we use from Successful Investing Coaching. So here's our sample portfolio that I showed last time we got together. But first, my usual disclaimers. This paper portfolio is an educational tool to demonstrate the concepts and techniques of the successful investing approach. And we use it primarily for our successful investing coaching clients. Over the years, we've demonstrated several variations on this theme, from keeping it simple with a strict adherence to the mechanical signals to a more nuanced rule set that adjusts to our perception of market risk in the current situation. It all forms, though, from that same base rule set. Its purpose is not to demonstrate how big a number we can put up to wow you. We are not a trading service. We don't generate stock picks, and we make no recommendations about any particular stock. That being said, here are the numbers. The last time we were together, this portfolio was at 10.9%, with a position in Lulu and Uber. I'm going to sort them by purchase date. Now we're up 19%. So notice the equity curve building from the lower left to the upper right. It doesn't go straight up, right? It bobs and weaves. So the portfolio pulls back. And on Wednesday on the big sell-off, we pulled back. We had peaked here at 19.48 and we pulled back to 18.31. Today's an up day, up 0.83%. Here we are at 19. So I anticipate, expect, and know that the market or the portfolio will have pullbacks. The key is I want to limit those pullbacks to keep building the staircase. The max drawdown on this portfolio, if you remember, has been about 3.64%. So the pullbacks pull back to a higher low. That's my objective. And remember, every stock in the portfolio has a stop loss in place, so I know exactly how much risk there is to the portfolio on any given day. So you can see, since we got together, we've added 5 positions to the portfolio on successive green lights. We've been buying one at a time. So we've diversified our risk by spreading out our purchases over time. Yes, we would have made bigger gains probably jumping in all at once, but we would also expose the portfolio to bigger losses if the market reverses suddenly. Notice that 4 of the positions have made it to the bonus round, what I call the bonus round, where their gains are over 10%. That's where we start protecting profits with our don't give back more than half rule. Notice the size of the positions, the extended cost basis. 6 of the 7 are all relatively close to that $11,000, 1/10 of my portfolio value. But the most recent edition, PLUS, is only at $5,500. So I took a half-size position, affectionately called a halfie in my vernacular, because I bought it after the 13th when the MTI was above 1.5. I'm using the exact same stop loss as I am on the other trades, but my risk on the trade shrinks from the usual 1 to 2% of portfolio value to half to 1% of the portfolio value on this particular trade. If the market resumes its uptrend with the MTI back below 1.5, I'll add the second half of the position as long as the stock keeps moving up. And finally, if I scroll to the right here a little more, you can see I'm diversifying risk by not over-concentrating in one particular industry. So the most I want to have is 2, maybe 3 positions at max in a fully deployed portfolio in any given industry. So software security is my biggest exposure with 2 of my 7 positions. So these tactics, coupled with my trade management rules, are how I'm mitigating risk in the market. And that never ends. So to be clear, if I go back to the market timing graph, from here forward, as long as the MTI is above 1.5, I'll remain defensive. If I pull back below 1.5 and the market starts rising again, I can buy back in on green lights, full-size positions. Rinse and repeat. If the market breaks down and continues to fall enough to give me a confirmed down call, then I'll start deploying my techniques of tightening stops and taking on bearish positions. Now I have a rule set in place that's putting the odds in my favor. In all these scenarios, I simply need to execute. I no longer have to have anxiety or make emotional decisions based on the heat of the moment. I simply need to look at the dashboard. How is the market performing and how are my stocks performing right now? I promised you some resources. Here's the special presentation, the one that I did back on November 16th, where we ran through the mechanics of the successful investor trading methodology. Also, a nice presentation Jim Penna did on how the MTI works, which goes into more detail of that MTI conversation we had today. Within the program, we have the Successful Investing Quick Start course available to you, which gives you the overview, a quick 90-minute study to give you an overview of the system and how it works. And if you come down to the VectorVest University, you can join the Successful Investor Coaching Group, where we offer daily guidance, weekly coaching, and have many other resources available to you as a member of the coaching group, and also peer-to-peer communication in our coaching rooms. So lots of ways to get involved and improve your game, but remember, your system determines your success. All of our rules are determined before we take the trade. This becomes an intellectual exercise and not an emotional one. Your system should put the odds of success in your favor at every decision point. So if yours doesn't, I'd humbly suggest you give Successful Investing a look. I invite you to join us at our next coaching session. But for tonight, thank you for watching, and I'll see you next time.